Hey guys, it's Chris Wong. For this video, I'd like to talk about investing when the market is high. So as a disclaimer, I'm not a financial advisor. I'm just a guy interested in building a portfolio. So this is what I'm doing for myself. It is not financial advice. I am continuously investing even though the market is up right now. So I just look at the S&P 500 and the Nasdaq, and I just look at the ETFs VOO and SPY. So I use those ETFs as a guide to see if the indexes are up high right now. I continuously invest because that way I don't time the market and I'm continuously investing for monthly distributions. So when I do invest, I will still calculate the annual dividends like I was actually going to get the same dividend for the entire year. So if the monthly dividend is still the same each month, whether the market's up or down, and I buy a share, I want to make sure that I still get a yield of at least 10%. And I still want some stability in the share price as well. So generally, when I am investing, I still expect a decent dividend per month. And then when I'm reinvesting dividends, I'm actually getting more shares next month. And my next month's dividend payout is going to be bigger. So I don't see the point of waiting for the market to go back down and then I'll buy more shares. The other thing to consider too is the indexes, the S&P 500 and the Nasdaq 100. They generally go up even higher after they go down. So the S&P 500 now is even much higher than it used to be. And to consider this too, whenever there's a down in the S&P 500, the down that goes down by is generally still higher than the previous ups in the previous years. The other thing I do when I do invest is when I look at my average price of buying shares, I actually look at what the current share price is. And if the current share price is still less than my average share price of what I bought all my previous shares, I may consider buying anyways, because chances are when I bought them before, I didn't buy them at the best possible time. So there's certain times I look at other sectors that are underperforming compared to the rest of the index. So for example, I might see that real estate is a bit down, or I might see that the utilities seem to be down. I may consider investing more into them in the time being. And then when it's time for my next paycheck and I find the index goes down and it seems to have a share price around what my average share price is of what I currently own, then I'll just buy more of those or put more focus on those when the time happens. But what I will say is I'm not going to stop investing just because the market's up. I'm going to continuously invest to increase my monthly distributions. That's my main goal. In the short term, if you can time the market correctly, sure, you'll have gains, but not many people are very good at it. Even some of the best professionals are not even that good at it. What actually is most successful for majority of people is long term. So I don't mean long term as in 6 months, I mean long term as in years, decades. The markets will go up and down on a regular basis. Every time it goes down, it's eventually going to come back up. Companies are going to do whatever it takes to stay profitable. And when the market comes back up, it comes back up even higher than before. So there's no point trying to time the market for most people because it's very hard to predict. If you liked the video, please give me a thumbs up. Otherwise, please subscribe to my channel for future videos. Thank you guys for watching.